We've already talked about the rise of passive investing. More and more investors are paying lower fees by hugging indexes. But what about the pros that live on these fees? What are these hedge fund titans supposed to do? That's what we're going to talk about on this week's episode of The One Thing. What's going on, investors? AK here. The classic hedge fund model is called 2 and 20. Basically, it's a 2% fee on assets and then a 20% fee on performance above an agreed upon benchmark or hurdle. So let's say you're managing $1,000 for me and we have a 2 and 20 model in place. The benchmark does 5%, but you manage to do 10%. That means I'm gonna have to pay you $20 for managing my money and then 20% on the 5% performance you did above the benchmark. So that's another $10. So this works out for everyone in this scenario because my $1,000 turned into $1,070, which means I made $20 more than if I just stuck with the index. And then you made $30 out of the deal. But an agreement like that is tough to keep long term because when you don't do so well, I still gotta pay you that 2% on assets. So that means you still get the 2% even if you don't beat the benchmark and even if you lose money. So if you stop beating the market and that happens, you're gonna be getting some angry phone calls from me. So recently with hedge fund returns slowing up and more people going into passive, hedge funds have been cutting their fees. Anthony Scaramucci recently talked about it on Real Vision.
I think over the last decade, we've gone from, on a hedge funds, we've gone from 2 and 20, so 2% management fee, 20% of the profit.
Probably 1 1/4 and 12.
Is that where it is now? So
yeah, I think so.
So we're 1 1/4 and 12
yeah, that's
on
what it
average.
feels like. Yeah, that's what it feels like.
What's the evolution of the hedge fund industry?
It's like our society. The rich are getting richer. The hedge fund community, the people that have the assets are growing their assets, and the other people are not. I mean, look, a lot of ways our fund of funds is like an outsourced multi-strat, right? So we'll outsource to who we think are the best and brightest in the space that we want. I think, good players are going to get more money. Weak players are going to get blown out.
So we just heard the Mooch talk about 2 ways to stay competitive. You can drop your fees or you can be really, really, really good. And if you could do both at the same time, that's even better. But there's also another option. You can be really different. Maybe you can pick tech stocks better than the next guy, but in all honesty, you're not gonna do that much better than a tech stock ETF. So where can you go to find an edge? Well, Kian Zandier of Sturgeon Capital is going to Uzbekistan. Here he is explaining the opportunity as he sees it.
Look at what has changed basically overnight. What happened was 2.5 years ago, the previous president, which was leading the country for about 25 years, died. And if you think of how the country was beforehand, there was a closed socialist economy, pretty much not like North Korea. It was completely isolated from the neighbors and from the broader world. What happened then was when the president died, the prime minister became the president. And the general consensus was that it would be a continuation of what was there before. But to everyone's surprise, overnight, he decided to completely reform the country and has been quite aggressive and ambitious in the reforms that he's taking place. So there are wide-ranging reforms which the government is undertaking. As I mentioned, the most significant one was the FX liberalization. What came alongside that was the capital amnesty, where foreign funds could basically come back to the country at minimal tax rates.
Uzbekistan's economic liberalization is providing a huge investment opportunity. And if you're one of the rare hedge fund managers who have access to Uzbek stocks, then you might be in a really good position. Along the same lines, Michael Schwimmer, the CEO of Big League Advance, he's presented an unusual investment avenue where he can charge actually more than the 2 and 20 fees. Using advanced analytics, he's able to invest in a share of the future earnings of minor league baseball players. These are the same analytics they use to beat Las Vegas odds makers. You got to check out the full interview to see what I'm really talking about, but here's a clip of Schwimmer explaining it a little bit more.
I want to raise money for 5 years. I want to raise a $130 million fund, and I want to do it at a 3 and 30. And my people back me were like 3 and 30, you're crazy.
Yeah, 2 and 20 is dying. How are you?
2 and 20 is dying. How are you going to get 3 and 30? Well, I think this is going to work. I think this is there. Like, all right, you can go try, and then we can cut it down when you're not successful. Well, 5 weeks later, we raised $182 million. I actually had to return $52 million because there's only so many baseball players.
Yeah.
So yeah, he actually had to return money to his investors because it's easier to raise money in some of these frontier strategies than to actually deploy it. So his fund might be small because it has to be, but maybe he's an example of one of those A students that the Mooch was talking about. Another area that's become really hot is crypto. Will Pease joined Real Vision to talk about how institutional players look at the market.
The awareness, the knowledge, the understanding is materially higher than even just a year ago. I think it's becoming too big to ignore, and so, and certainly, with Yale and a few other pension funds or endowments entering the space, that's kind of eased. It's made it easier for others to kind of reduces some of that career risk and the headline risk of being the first mover into, again, a very new asset class where I would say a majority of the investor public is misinformed or underinformed at a minimum. yeah, so I think that's progressing. I think we would have expected it would have happened more quickly, but it's directionally going in the right way. So
What's so funny is like back in 2017, I think that was the big theme. It's like, oh, institutional money's getting into it, but everyone moves a little bit slower than that.
Yeah.
And now we saw, now it's actually coming in, and it's like no one cares. Which is, I mean, they're starting to, but
yeah, and I think we've still just at the tip of the iceberg of actual capital coming in. Right, there's been a lot of announcements over the last year about the likes of Fidelity and Bakkt, and now you have TD Ameritrade and E-Trade, offering, but those offerings are still in they're just onboarding initial clients, or they're only offering it to a subset of institutional clients. So you really haven't seen the floodgates open, but you are seeing kind of the groundwork as it relates to infrastructure, being laid, and these people are investing a lot of capital, or these companies are investing a lot of capital to make these offerings, available.
So on top of retail and classic hedge funds being interested in crypto, there's institutions like pension funds trying to get in too. And that's pretty wild considering that a few years ago they wouldn't touch crypto with a 10-foot pole. And of course, because we're talking about creative ways to harvest alpha, we gotta talk about cannabis. Todd Harrison recently joined Real Vision to talk about the cannabis markets.
We're investing in the cannabis space or cannabinoid wellness space across the US. We have some Canadian exposure, but really US, biotech, Australia, some Europe. We're looking out 3 to 5 years. We think the market is misunderstood here. Certainly the total addressable market and the use cases are misunderstood, so we're positioning to take advantage of that. If you look at this and you use the .com parallel, that there's going to be a lot of companies that don't make it, but the ones that do are going to be generational opportunities, and that's how we're looking at this. And trying to look through all this near-term volatility, it's a lot of retail holders right now, notoriously emotional retail holders that are moving with a herd mentality, which is why we're seeing these monolithic moves across the space.
So as funds continue to search for alpha and they continue to search for fees, they're having a hard time finding it down the traditional avenues. So they're taking side streets. Traditional funds are lowering fees, but funds like Schwimmer's are actually raising them because they could argue that they found a competitive edge. Others, like Todd Harrison at CB1 Capital, they're focusing on specific parts of the market to hone in on an edge. Even the large institutions have had to adapt. That's why pension funds and endowment funds are turning to crypto. So instead of saying that passive is killing active, maybe we should say that passive is killing uncreative alpha. If you want to get introduced to more of these strategies, or maybe you want to help building one of these unconventional theses, then make sure you subscribe to Real Vision. I'll talk to you next week.